I have the best job in Pittsburgh. My name is Don Morrison. I'm chairman of Deal Flow for Blue Tree Allied Angels. For the last several years, I've been meeting with wild-eyed entrepreneurs, hearing their stories of market disruption and world domination. And it's a very exciting place to be. Today I'm going to talk about how to pitch to angels. Before we start talking about how to pitch to angels, I think it's important to understand who angels are, understand the funding process, and also understand the angels' place in the funding landscape. So who are angels? They're often successful entrepreneurs or retired professionals. They're accredited investors based on the SEC definitions. An important thing to really understand is angels invest their own money, not money managers with some fund. Angels generally invest in local companies. They invest in businesses not run by families. And they really invest as either individuals or through an angel group. Why an angel group? One of the advantages of angel groups is the power of aggregation. Several angels can pool their money together and have more clout in terms of negotiating term sheets with entrepreneurs. It also mitigates the risk. It mitigates the risk in a couple ways because of the due diligence that angel groups provide. There's a wide body of experience and knowledge within most angel groups. There's typically a higher quality of deal flow with angel groups and greater investment clout, and also the ability to manage a portfolio. What's the advantage to entrepreneurs of working with an angel group? It's a diversified business experience. One of the things we do at Blue Tree is we invest more than our capital. We invest our experience and our Rolodexes. As companies get off the ground, it's really important to be able to reach out to industry thought leaders and be able to have doors opened. And a lot of angels can do that because of their connections and experience in the market. There's also extensive industry contacts and opportunities to syndicate. Blue Tree often does deals where we co-invest with other angel groups throughout the country. So amounts of money that are typically beyond our bandwidth, we're able to help a company raise by bringing in some of our angel groups throughout the country. The slide that you're looking at now shows the growth in the number of angel groups throughout the country. This slide only goes through 2013 and shows about 400 angel groups. The number of independent angel groups today is closer to 600. So it's a remarkable continuing growth of angel groups. This next slide is very important and has a lot of information about the funding process, the funding landscape, and angels' places within the funding landscape. The top line shows the product stage of the company, from technology discovery, proof of concept, initial design, the test and development phase, build and deliver, and scale. The next line shows the amount of investments that are typically needed with most companies. To the far left of the graph, it's really the pre-seed and funding. Typically at this stage, you raise money from the friends, founders, family, and some would say fools, the 4 Fs. And it's typically tens of thousands of dollars to get the company up and running. As you move further to the right on the spectrum, you get into the pre-seed and seed funding, and that's where individual angels and a little bit later angel groups come into play. At the bottom of the chart, it shows company valuation. And this is a very important and often overlooked part of telling a story to an angel group, and that's what's called the pre-money valuation. Typically that means how much is your company worth before the angels put their money in. And you'll see it starts off in the $100,000 range up to multi-millions. There's no exact formula for coming up with the right pre-money valuation, but Blue Tree is part of that 600 angel network, which is the ACA, Angel Capital Association. And the ACA shares data every year on typical angel investments. The average pre-money valuation for most early stage companies within the last several years is between $2.5 and $3 million. If you go out with a pre-money valuation in that range, you won't have any problems. If you're significantly higher than that, You better have some issued patents. You better have established cash flow. There might be other extenuating factors, such as a serial CEO who's made a lot of investors a lot of money with other companies. But if you don't have one of those things, it'll be very difficult to raise money with a pre-money valuation higher than the industry averages. And like selling a house, if you go out too high when you come back to the market and say, well, we thought we were a $9 million pre-money, it's now really $3 million, there's somewhat of a tainted aspect to downgrading the pre-money valuation. So like selling anything else, you want to set the price fair, and the truth is it's going to be a negotiated number. So, but it's very important to understand the process and the flow. If you look at the different funding mechanisms, you'll see angel groups are right in the middle. And to the right of angel groups are VCs, and we'll talk about that on the next slide. Angel groups invest in 90% of startups in this country. This data from 2013 is somewhat dated, but the ratios haven't changed that dramatically. You'll see that in 2013 there were 71,000 deals that were funded by angels and only 4,050 deals funded by VCs. That's approximately an 18-to-1 ratio. So if you're starting a new company, your chances are 18 times better of getting funded from an angel group than from a VC. The next graph basically shows the same numbers in a bar graph format, but it's basically reinforcing the total number of deals started and invested in by angels versus VCs. What's really important is telling your story. Telling your story also is the elements of the pitch that you need to put together when you come before angel groups. Most angel groups will give you about 20 minutes or so it's really important to understand how much time you have. And what we recommend at Blue Tree is between 20 and 25 slides. To get funded, entrepreneurs need to tell a compelling story. Your story or pitch must contain several important elements. You've got to talk about your product or service. You need to talk about the market size, market opportunity. You need to talk about your business plan. You need to talk about your sales and marketing strategy. You need to show your financials. You need to have a management team in place, and you need to talk about your exit strategy. On the product and service side, your product slide should explain what the problem or pain is are you addressing. Is it a big problem? Is it a real problem? Are you a solution looking for a problem, or are you addressing a known market need? Who's your target customer? Who are your competitors? Please don't say you have no competitors, because status quo is competition. And if you come to in front of any investor group and say, I have no competitors, it may be true for your specific approach to a problem, but there are many, many problems. And the challenge is getting companies to switch from what they're currently using, the status quo, to your new improved product. What's your product differentiation or your compelling advantage, your competitive advantage? How does it work? What's your value proposition? You know, a company can do something faster, for less money, more efficiently. Those are important parts of your value proposition. The more specific you can be about that, the more compelling your story. What are the barriers to entry? Are you going to be protecting your idea with patents, copyrights, trade secrets, or are you simply a first-to-market strategy? What are the risks? Are there technology risks or regulatory risks? Those are important parts to include in discussions about your product or service. The market, you need to address the following questions about the market for your product. What's the total market size? Is the addressable market for your size large enough to be interesting? What's the growth projection of the market segment that you're going after? Is it growing? Is it flat? Is it declining? What percent of market share do you expect to have in 5 years? The business plan is going to be talking about your use of the funds. What is your revenue model? Are you a recurring revenue? Are you a licensing play? One and done? It's important for the investor to understand how you make your money, what type of revenue model you put together. Also important is to understand what assumptions you're looking at regarding your financials. What's your pricing and margin assumptions? What's your SG&A, your selling and general and administrative cost assumptions? What are your supply chain assumptions? How will you scale is very important. What is the long-term prospect for your product to extend into other markets or into other silos? Sales and marketing. Even the best ideas go nowhere without a sound sales and marketing strategy. Your sales and marketing slides should address your go-to-market strategy. Are you going to go after direct sales, channel partners, licensing, etc.? What's your cost of customer acquisition? What's the length of scale of the sales cycle? Are there any regulatory drivers or regulatory barriers that need to be considered? Financials, as part of your story, need to show a 5-year trend. For your initial slide, what we recommend is just a very high-level overview of your revenue, your expenses, and your EBITDA or profits. In your backup slides, I recommend after your 20th or after your last slide to have auxiliary slides, and oftentimes you can have a more detailed 5-year P&L in case during the Q&A people ask more detailed questions. But for your initial slide, you really just need a very high-level revenue, expense, and profit. How long and how much money will it take to get to a break-even? This is something that's really important for entrepreneurs to understand. We understand that it's a guess, but we want to understand that you've given thought to those guesses and understand the assumptions behind your guesses. How much are you asking for? It's very important to be clear in terms of the specific amount you're asking for. Also, many entrepreneurs make the mistake of looking for too much too soon, and it's much better to have a staged strategy for raising money rather than trying to get $10 million in your initial raise. Ask for $500,000, $2 million, whatever, and clearly spell out what milestones that money will get you to, and then at the next milestone, what your next fundraising strategy will be. What is your use of funds? How will you use the money that the investors are going to put into your company? Will you use it to hire key people? Will you spend it on research and development? How much will be spent on marketing? Those are the kinds of things that you need to explain. How much have you raised to date? You've raised no money, you've raised some money. Where did that money come from? These are also important inclusions in your financials. How much additional capital might you need? This is important because investors who come in early with a lot of companies oftentimes get diluted by later investors. So that's a concern of every investor in terms of how much additional money downstream will this idea take to become fully realized. And pre-money valuation. There's no magic formula there. As I said before, 2.5 to 3 million is the national average. You can be higher than that if you've got some really sound reasons for that, such as patents or a super experienced management team. Your team is really the key to your whole project. You really need to talk about the team because they're going to be the ones responsible for executing the business strategy. Your management team slide should include, information on the CEO's startup experience. Who are the other key managers on the team? What are their skill sets? If you have 5 engineers and developers running the company, and there's no business development experience, that can hurt you. So it's important to have a balanced management team. That team also includes your advisory group. It's really important to understand what you do well and what you don't do well. And in the cases of areas where your core team doesn't have experience, it's really important to put together a seasoned, experienced advisory panel that can help you in the areas that you're deficient. A thing that's often overlooked with entrepreneurs is including a discussion about your exit strategy. A lot of entrepreneurs talk about their product, get excited about the product, but what investors want to know is how they can make their money back by investing in your company. So every investor wants to know how they're going to get their money back. This typically happens through an acquisition, occasionally with an IPO or initial public offering, but more often than not it's an acquisition. So your exit strategy should include, who might acquire you, what other companies have been acquired in this space, for how much, what were the multiples on the exit in terms of multiples of EBITDA or multiples of revenue, and how long do you think it will take for your company to exit. So the pitch itself, here's some tips on presenting an effective pitch. Plan on a 20-minute pitch, and it's important to really understand before you go before any investment group exactly how much time they're going to give you, because you might have 15 minutes, you might have 30 minutes. So understand exactly how much time you have, put your slides together, practice, 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 and less is more. If you put too much information on slides, most investors during a pitch session just don't have the time to read it. So it's more important to put a few bullet points on your slides and let your narrative do most of the communication. Avoid the beautiful baby syndrome. Most entrepreneurs are reasonably good-looking people. We know your offspring will be good-looking because you're a good-looking person. So what entrepreneurs forget is they're speaking to investors and they want to know how they're going to make money with your beautiful baby. So tell us about your beautiful baby, but tell us about the exit. Get feedback before and after your pitch. Practice in front of your friends, family, coworkers. Get feedback, and that's very, very important. All the companies that present to Bluetree get feedback within a few days of pitching to us, whether they've made it through or whether they've been declined. Many companies that don't make it through on the first pass are often invited back and succeed on their second and sometimes third attempt. The last thing I'll say is to be excited and be passionate. Entrepreneurship is a fun, exciting business. If you're not excited and passionate about your idea, it's going to be difficult to attract investors to it. If you're not excited about it, it's going to be difficult to get other people excited. There are a lot of great resource information available. They're posted on the slides, and I highly recommend to do some research and learn the best way on how to pitch to angels.